Good morning, everybody. Welcome to the Flow Show, Thursday, the 4th of September. All holidays done and dusted now till Christmas, probably. Summer's over, kids are back at school, and it's stopped being sunny. Absolutely pissing down for the last week or so. The end of summer is here. Kay, got your umbrella out?
Yeah, absolutely. It was raining so hard, I was wondering if I needed to open an umbrella inside as well at some stage. Yeah, summer is over, mate. Although, looking out of my window, I see a very, very shy ray of sunshine. So there is still a bit of hope for an Indian summer.
Yes, it seems to happen a bit like a light switch. 1 minute it's boiling hot, and the next minute it's the end.
Absolutely, absolutely.
Yeah, that's it. It's done and dusted. Anyway, enough of the weather. Let's get cracking because there's quite a bit to get through this morning. Right, according to Japan's Akazawa, who's been over in the US, all the administrative issues have been solved. Things have been put on paper and signed, sealed, and delivered, and whatever. All he's waiting for now is President Trump to put through presidential orders about the agreed tariffs. So everything that's been agreed, nothing has changed there, but as I've been saying for weeks since the trade deal was first announced, Japan wants it all written down and binding, shall we say, on paper. Well, he's got half of that now. He just wants a presidential order. RBA Governor Bullock says that if consumption keeps going up, it's possible there might not be as many rate cuts. The old hawkish governor there showing her feathers, says that consumer recovery is welcome and is a little stronger than we thought. A bit of data out this morning. We had some inflation data from Sweden, which showed a little bit mixed numbers. A lot of numbers showing higher. Headline CPI at 1.1% as expected, although one of their core numbers came down, or the ex-energy number came down to 2.9% from a prior 3.2%, but some other numbers still higher there as well. But on the month, a bit softer on their constant interest rate metric there. So overall, some inflation going up, but that ex-energy number coming down. That got Riksbank's Jansen out, saying that the core inflation seems a little bit of good news. It says it looks like the high summer inflation looks temporary, but the economy is weak and the recovery is sluggish. And Sweden has just decided as well to cut VAT on food in half to 6% from 12%. So that might be a little bit of easing and price pressures there as well. Kate, overall, those inflation numbers, you wouldn't call them dovish or bearish, but keeping Jansen happy. So further cuts on the cards?
According to him, yes, but I don't think it's a general consensus. Well, further cuts, yes. I think they said as much, but I don't know in how far they can continue to go. Yeah, I think it's an open question over there. I haven't really been trading Swedish kroner for a while. It's doing okay. It's really actually doing quite well during this well, the last weeks and months. Like everything else, it's been in a range if you look at the dollar side of things. But yeah, Euro stock is slowly continuing to slide lower. So I don't think it's going too badly over there. Do those central bankers just like to complain over there? It's possible. I will need to look up their global comments. I don't think they are an extremely happy bunch over there, but yeah, there's this other one, the governor. I think he's much more neutral than Jansen is.
Yeah, very much so. We also had Switzerland inflation out as well, coming in a little bit softer than expected on the month, though unchanged on the year, 0.2%. The EU harmonised number, though, came in year on year down 0.1% versus prior, plus 0.1%. Core inflation came down to 0.7 from 0.8. Anything there for the SMB? Hardly say it's they're in an inflationary environment still.
No, inflation is dipping further. S&P is already at 0. When is the next meeting, by the way?
It'd be this month, won't it?
Oh, yeah,
September.
it's this month on the 25th.
Yeah.
It's this month. They threatened to go into negative territory, but as we can see from the market, nobody is impressed with anything in the Swiss franc still. If you look at the Euro Swiss is still trading extremely range bound, really range bound. We had a bit of a look there in August up above 94, couldn't hold it. Now we're back trading miserably in that 93 zone.
Yeah, I'm stuck below that 94 level again as well, as I can see there for a few days. So yeah, it's well stuck within the range there. So what do you reckon they do? Do you reckon September's a live meeting for them?
They will have had the FOMC and the ECB before, right? ECB should be on hold, but the Fed is going up obviously to be the very interesting one. Could there be kind of a reactionary cut if the Fed drags dollar Swiss or the dollar in general further down? Could be. If you look though at all the economic data altogether, they are not. Well, I mean, it's a bit European style, a very anemic growth, but they haven't particularly been bad. The economic data, but they're also wrestling with potential more tariffs on their pharma companies, etc. And there, they may be pushing to get the Swiss francs cheaper to export a little bit easier. So let's say in the facts, I would not think there is an absolute reason to go negative yields, but it's SMB.
Yeah.
We have seen though that Schlegel is not the kind of interventionist that Jordan was. So I think it's all wide open, mate. I'm just saying that they could be tempted to do so.
Yeah, thanks, mate. Coming into a bit more data, let's give it a that. Let's go back to there. We had some construction PMIs out and not looking overly hopeful. Italy went backwards, 47.7. Germany went backwards, 46. France, they saw a bit of an improvement there from 39.7 to 46.7, still in the negative though. And the pan-Eurozone number also ticking up a bit on that. Then we've got the UK construction PMI, which also saw a little bit of lift up, but still well into contraction. And Eurozone retail sales a bit soggier on the month for July at minus 0.5%, year on year softer at 2.2%. We also got from the UK, we got the DMP inflation expectations. 1 year inflation expectations rising to 3.4% from 3.2%. 3-month output price expectations staying unchanged at 3.7%. So the what's called the decision maker panel, that's all firms and businesses and whatnot, seeing higher inflation in the pipe coming as well, which falls into what BOE's Bailey was saying yesterday. PM Starmer, UK PM Starmer, explaining away the constant pressure on UK yields, particularly at the longer end, saying borrowing costs have risen across the world, which is funny because they didn't use that excuse when the same thing was happening before Truss took over as well. Chancellor Reeves is apparently not happy with the NISR, the research think tank jobby, because previously they had a report out saying that the UK faces a 50 billion budget gap, i.e. a 50 billion black hole. She says in recent years, the NISR has got their numbers wrong and that serious economists don't expect the UK to need help from the IMF. Well, serious economies, that rules her out, even though she's supposed to be Chancellor, and apparently said she was an economist. We had a load of BOE bods up before the beaks yesterday, Treasury Select hearing. BOE's Taylor, the man who tried to vote, should I say, for a 50 basis point cut at the last MPC, says my main concern has been to get inflation sustainably back to the 2% target, maintaining monetary policy restrictiveness as long as necessary, but no longer, which goes against voting for a 50. Anyway, he then says greater danger is that we get behind the curve and stay too tight in the short term, hence his reason for asking for a 50. BOE Green says she voted to stay on hold as the risk of inflation persistence was higher and the risk of weak demand was lower, and is not convinced UK rates are now meaningfully restrictive, i.e. they could be moving into where it sort of expands or helps to expand the economy. Bailey, after letting his counterparts waffle, said the risk of inflation has risen and more concerned about downside jobs risks than MPC members who voted to stay on hold. Sees a path for rates continuing to be downwards, but there is considerably more doubt on how fast we can cut rates. A very undovish comment there. It says market pricing suggests my message has been understood. They're also waffling on gilt yield, says should not over focus on 30-year gilt rates. It says higher short-term rates help explain UK yields, and says tariffs aren't as big a part of UK inflation story as expected. He then moved on to QT, saying decision on QT is an open decision and there's no pot of gold for public finances if the Bank of England takes a different approach to QT. It says our open decision will take into account an interaction with markets, and also says that QT is not the cause of the increase in bond yields. Kay, you were obviously about for all that. It seems the PMI yesterday and an undovish Bailey has helped the quid a bit, but none of them know what's going on and what to do with rates, it seems.
The recovery in bonds was already ongoing when they spoke. Actually, through the whole Treasury Committee hearings, Euro sterling. If you look at the measurement for strength or weakness, let's say as being the main cross that's traded in sterling, it barely moved. We had like a 10 pip range in that euro sterling while they were on waffling on. Yeah, it was a bit of a funny one. That hearing I listened to, I think, the first hour or so before completely hooking off. And hearing Lombardelli and Green on one side of the table and Taylor on the other side. And then Bailey in the middle somewhere, because he did say the path is clear, but we don't know. And he clearly was there with a bucket of cold water to try and extinguish the fire on in the bond market as well. Which, to a certain extent, looking at how the bonds are trading, we may say that he hasn't spooked the market at least, and in a way, he's not completely wrong that for their monetary policy, it's not their main target is not to the longer term yields, right? But monetary policy is more focused on the shorter end of the curve. But so he's not completely wrong there. Yeah, but for the rest, there's very little to say apart from the fact that on balance, and we saw that already at the BOE meeting, they are less dovish than what the market would like.
Yeah, and we still got this sort of divergence between short term and long term. The budget's now been announced 26th of November. There's going to be a lot of eyeballs on that. Probably we won't start really trading it until maybe October when we start getting the super nuts from it. But we're in this position again where the sword of Damocles is on the fiscal side is hanging over, but we're getting a bit of better data, and inflation's holding up. So it's, what do you do? What side do you sit on? If you're short term, probably buying dips in the quid is the way forward, but longer term, I still see storm clouds.
Exactly, and I think that's where the market is at now as well, Ryan. Okay, I mean the bond market is a different thing than FX, but if you look at FX, you get this move, and then it fails is a big word, but it just stops, and people who are in short-term positions get out of their positions, which is exactly what is happening again right now in the euro sterling, and we are just waiting for bigger. Yeah, bigger worries to hit. It's going to be a scramble, that budget, right? It's and there's not a lot right now. Right now, there's not a lot which can be said positive about it, right? So I don't know whether there's going to be any also surprises that could really be positive. But then, as you say, still over 2 months to go. There's a lot of water to flow through the Thames before we get to the budget, and there will be a lot of oh, let's try this or maybe not, and all those kind of things coming as well, right?
Yeah, exactly. And one thing we should be on watch for is that the Chancellor will probably drop some leaks to go and test the market, what it thinks about certain policies. We've seen this time and time again, particularly around UK budget. So they'll float a tax change or a policy change for the budget, see how everyone reacts to it, and then deny, if it goes badly, deny that it was ever on the docket in the first place. So we should be prepared for that over the next few months. Right, moving on from those clowns. Anyway, over in Italy, the economy minister there says his League party are going to discuss ways to collect resources from financial institutions to fund budget policies. Now, that may not be a big story in itself, but if you're a financial institution in Italy and you think you're going to get hit, then there's a good chance that you're going to get out some assets, or indeed maybe even the country itself, or look to trade elsewhere. So this only a little story at the start, but a bit similar to the UK. If people are going to start getting taxed, then you're going to get rich people leaving. If Italy's looking to hit their financial institutions, well, it could cause them to change jurisdiction. And one of the benefits of that will be the good old US, probably. So just keep an eye on that if it picks up head of steam and spreads to other countries. Germany's IFO, they're all bullish on the German economy still. They cut their growth forecast for 2025 to 0.2 from 0.3, and 2026 from 1.3 to 1.5k. Can you remember the last time anyone actually upped German growth forecasts in the last 5 years?
No, I don't think so. Maybe the odd 0.1 somewhere on a quarter, but no, I don't recall. No.
Rare as rocket, was it rare as chicken's teeth or something? I can't remember. Rocket bullshit.
Yeah, something like
Anyway.
that. And then it's not only one, you get like two institutions the same day, half an hour apart from each other, coming up with the same downgrade of growth expectations.
Yeah, exactly. So they're all heading to zero. Everything heads to zero on a long enough timeline. Right, going over to the US yesterday, and some of the data we got out of there. Jolt came in a little bit softer at 7.18 million versus 7.38 million. Where is it? There it is, right in the middle there, and a lower revised 7.357 million. So not looking good there. I would say though, for Jolts, we're in a bit of a range really between sort of 7 and 8 million. After coming off these highs, we've sort of just hovered around this. So really, unless we're breaking 7 million or back above 8 million, this is just ranging for a bit. The quits level came in a bit higher at 3.208 million from 3.14 million previously. Quits can be used as a measure of people who are changing up jobs. So a higher number can mean it's a positive there. Although layoffs rose to 1.808 million from 1.6 million previously. So that wasn't good either. Sorry, Kay, got something on the jokes?
Oh, no. I was just agreeing up on that, and it's a bit stalling on the hiring front as well. It's an I would say it's a weak-ish report, but perhaps not enough to raise big red flags, right?
Yeah, and this is lagging a bit because this was July data.
Yeah, as well.
We're about to get the August NFP, so it does lag a bit somewhat. Factory orders came in as expected, down 1.3%, which wasn't as bad as last month's minus 4.8%. But again, there's some fairly big swings in these numbers at the moment. So some of the aircraft defence stuff that's been going through, take away the transport aspect, and factory orders rose 0.6% as expected. We also got the durables revision, which were largely unchanged, so nothing out of that at all. Right, load of Fed heads have been waffling. Fed's wallet says 10-year Treasury yield has been kind of anchored. It says we should cut at the next meeting. We could see multiple cuts, but whether that's every meeting or every other, we'll need to see what the data says. But he sees multiple cuts over the next few months. Says we know we'll have a blip in it of inflation, but it won't be permanent. 6 months out, inflation will be closer to 2%. So he's making a little bit of a call there. So mark this date for 6 months' time. Says he's not had an interview for the Fed chair job and doesn't have one scheduled. That could be ominous. Fed's Muslim says there's a risk tariffs could cause persistent inflation rise. So going against what Waller's just said. Says the central bank's current restrictive monetary policy is in the right place given the data. So tariffs will work through the economy over 2 to 3 quarters. Expects tariff inflation, though, to fade eventually. Says the jobs market break-even level is between 30,000 and 80,000 jobs per month. So he's round there or thereabouts, what somebody else has been saying, 50 to 75. Note that there's a few more Fed people talking about this break-even number, which can be a bit of an excuse if we start getting some of these softer jobs numbers, NFP numbers. Fed's Bostic says he's not ruling out a September cut, depending on the coming jobs report and other data. Still think tariffs' effect on consumer prices won't fade fast and could take months to materialise because firms can't absorb higher tariffs much longer. Fed's cash and carry says the Fed has more work to do to bring inflation back to 2%. Inflation is still too high and the labour market is showing signs of cooling. Says we're getting into a tricky situation with the Fed's mandates. Data suggests economy is slowing and moving to a soft landing. Goods inflation is rising because of tariffs. Also says the jobs market break even may now be 75,000. And that interest rates have some room to come down gently. Trump says it's possible that tariffs in future could replace income tax. Good luck with that. He's talking about the court cases as well. Says we're going to have a very big case at the Supreme Court on tariffs and that the US could be rich or poor depending on that case. And if it all goes wrong, he says, I guess we would have to unwind trade deals, which will please Japan to no end. Kate, all this tariff stuff, as Michael in the room's pointed out, there's other ways of putting all these tariffs on, but it's going to be a kick in the teeth if he does lose his court case.
Yeah, absolutely. And then we don't know what the reaction may be because, as he already said, it may mean revisions of trade deals. I mean, imagine that happens. It's going to be an absolute mess, and I probably want to take a week off and come back and pick up the pieces. Because I mean, there's really people will have their opinion about it, but again, yes, there are ways to do it. We know that he plays on the sentiments when he says that that's a decision that will make America rich or poor. Yeah, it could be a real mess. I don't know. Just in case that they vote it away before there are new ways being put on to have those tariffs, it's probably going to be a case of gold hitting close to 4,000 or so. That's kind of my main idea about it. But for the rest, I have no clue because we have seen both reactions on tariffs and a higher and a lower dollar. I would say though that if Supreme Court votes against the tariffs, the first reaction would be the dollar to get hit, right?
Yeah, that's what I was going to ask. What's the move? I mean,
Yeah, I
is it
think whatever.
is it a credibility thing again? You know,
Yeah.
we've gone through 6 months of this, and
Mm.
then it's all up in the air. Is the market going to go? You know, he doesn't know what he's doing. All this uncertainty. We thought we were coming to the end of it, and now it's up in the air a bit.
Yeah, I mean, but that's the thing is not that he doesn't know what he's doing. He's doing the wrong things. And also the reason why I think that the dollar is going to get hit is that um, is the rest of the world doesn't sit still, especially that Asian side of this planet, and people will not invest in China or Russia or whatever. I don't mean that, or India, but just yeah, I mean, an investor thinking like, all right, America is a joke right now. Do I really want to keep my money there? And then you will see the bond market in the States also get hit because the market will say like, well, if you can't slap tariffs on that leaves us with the big beautiful bill that needs to be funded, and then they have a problem in the States with that.
Yeah, and that probably mean the euro potentially on its merry way towards 120 if
Oh
that
yeah,
happens.
yeah,
So
yeah. I think really, my first reaction would be the dollar gets hit pretty severely.
yeah, yeah, mine too. Right, so yesterday we had OPEC Plus saying that, or sources saying that OPEC Plus is going to consider another oil production hike at this Sunday's meeting. And then that got torpedoed this morning by Russia's Novak, saying that OPEC Plus nations are not discussing a hike now. Putin's been on the waffle saying if the meeting with Zelensky is well prepared, then I'm ready to meet. Says let Zelensky come to Moscow and a meeting will happen. If that's not a bit of bear baiting, I don't know what is. But anyway, that situation is still running over. Trump still talking about getting the meeting, having a meeting with both parties, but time's dragging on. He said 2 weeks would be he'll know what's going on, and we're entering final week, so nothing's still going on. So that's potentially going to come to a head at some point. Right, Kate. Anything else? Anything else I missed?
Um, no, just a couple of things. Well, a couple. Just one, the DMO in the UK, the Debt Management Office, having seen when the autumn budget will finally be presented, has taken note of it and removed one, pushed back on a couple of other auctions. So that's probably what's helping the bond market in the UK, the gilt market in the UK today a bit as well. But it's just basically pushing back a few, and then they did actually remove one, but then they brought another one which was supposed to come in later, a bit forward. But all in all, yeah, a bit of a pushback against the calendar wise for the auctions. Not that it will matter at the time when we will be there, but in the meantime, it does seem to quiet down the gilt market a bit as well. So, and that's basically it, mate.
Yeah,
Not a lot else to say, really.
yeah. Let's see how long that lasts. Anyway, right. Just looking ahead to today and what data we've got coming. We've got ADP. This is a lot of this data is delayed from Wednesday due to the Monday's holiday. So two things to keep an eye on: Challenger job cuts, just to see if we're going to continue seeing some higher layoff intentions. This one already had the government. I'll show you the chart. This one already had the government payrolls layoffs when they were announced back earlier in the year. So you're not going to see these coming through over the next couple of months. We'll see the how many have actually been made redundant or lost their jobs over this one. But we've been running sort of high-ish of late, so just keep an eye on that in case there's any surprises in there. And then we get the ADP, which is there or thereabouts what we're expecting from the NFP numbers as well, 73,000. So keep an eye on that, and keep an eye on the sectorial changes as well, where the jobs are being won or lost within that. Just gives you a little clue what sectors are doing well and what sectors are not. Then we get a bit of Q2 labour cost data, productivity data. So just keep an eye on that one, because that will all feature into the Q2 economy stuff there. A bit of trade balance data from Canada later after that. And then it's ISM services in the latter part of the afternoon. So market obviously be looking at that to see what's going on in terms particularly of employment and prices. So that number is expected to rise to 50.9 from 50.1. And so there's been a couple of surprises in these numbers of late compared to what the S&P numbers have done. But that was a good reading that we got previously in the S&P one, 55.7. Is this one going to follow? Anyway, we'll see what happens later. Right, looking at prices, I'm just going to have a quick look at, because obviously been away, so I'm not fully clued up yet, but a couple of positions I'm in and managing around. Euro sterling, that did get up to that 87 level. We're talking about this, it took near enough 3 weeks for us to get through the top of this zone. And when it did break, it broke quite strongly up into the 87s, nicked a little bit off my longs. But otherwise, this is really just ranging 86s, 87s for now until we get a catalyst. We do have UK retail sales tomorrow, which is expected to be another positive number, given all the great weather we've had through the summer. So the surprise will be if it's a bad number. If it's good, then it's going to show the consumers been a bit spendy through the summer. This will be July data, so that should continue if it follows the same thought process into August numbers as well. But September might be a bit of a falling off the cliff moment. But obviously we won't get that data until October, November. So a long way in the future. But just if you're looking at retail sales from the weather impact, the weather's been shite in September. So expect that to feature in the data. So, as I was saying, short term, I can see a case for this, for the pound gaining here a bit and maybe seeing a dip. If we get down to this bottom of this zone, that will be an important point there if we hold it. It was trying to hold the top this morning, but that's been knocked out. And as Kay mentioned, if you look at UK yield, well, all yields at the moment, they're having a bit of a off day. So all yields are down across the board. And there's more worries in the UK than there is elsewhere, so that's why we're seeing the pound reacting to that. But otherwise, we're really stuck in the middle of this range. Ali, you say you're long at 86.92, all right up against the top there. So I don't know what picture you got on your chart, mate, but we're definitely in a bit of a range here. And what is it, 52 your stop? I hope you don't get hit, but you're not far off that one at the moment. So yeah, stick to your ranges and just trade these. Don't try and get caught up in the middle or thinking things are going to break or not. Either wait for them to break and confirm, or sit on your hands and wait for better levels to get in. I've been adding to my Aussie Kiwi shorts. It's still looking very, very strong in this one. Let's take it on the wider chart for now. So we're potentially getting up to some of these big range tops or intra-range tops. We've got several ranges in between or around this 108 area. These high 111s is one of those points. We tested that time and time again. We have had breaks. It has moved on and gone up. So there is the possibility that we do that again. This is still looking very strong. So I'm looking to add a little bit more if we get up to that level there. And then if we break above there, I'll judge the reason why we're breaking up there as to whether I close up or keep going on the shorts. I have got an inclination to be trading even up to this wider range edge 114, but there'll be a long way away. I'm keeping the position small, so we'll see. The Aussie dollar just seems to be continuing to fly while the Kiwi's a bit stagnant. Is there any big reason why? Are we following stocks? Are we following gold? What's following China?
In a way, I think between Aussie and the Kiwi, Aussie is better bit, and it could be related indeed to gold. But then Aussie got a little knock on the head because yesterday we were trading at 111.5 in the Aussie Kiwi, right? Aussie got a bit a knock on the head this morning overnight when the Chinese came out with those comments saying that they want to curb some speculation in the Chinese stock markets, and that per correlation has hit the Aussie as well. I mean, that's what I suppose anyway, because there was nothing in the data to see sellers in the Aussie emerge.
Yeah, I forgot to mention that one. I knew there was a headline I missed.
Yeah,
a bit of a strange one from China. They don't want speculators selling it, and they don't want speculators buying it.
Well, that's why that China wants things to be gradual and steady, and it's the same thing. It's the same thing with their currency. It's the same. They want to have control over their markets, and I mean, if you look at their reserves, etc., $3 trillion, say they can have control over their markets. But yeah, they said that they're proposing measures to make it all a bit more steady, etc. And really, there we saw a bit of the correlation as well, Aussie China, Aussie gold, because at the time that story came out, gold also got whacked for $50. So yeah. Aussie is as you were talking about Aussie Kiwi. Aussie is quite related to what's happening in gold and China still, because as again on the data front, I don't see too much to why Aussie should get hit, and I think it's just the timing of that article.
Yeah, and Ali, I'm going to answer your question with a question. If a currency is not moving on its own fundamentals, then it's moving on something else. So if Aussie dollar isn't moving on Aussie fundamentals, what is it moving on? There's your answer. Obviously, it's not moving on the Aussie side, it's moving on the dollar side. So there's always two sides to a pair. But again, yeah, this one's just been range bound again. Can't get a hold, can't get up to that 66 level and get a hold if it does move above. But it's not really breaking down either. So yeah, we're just doing what a lot of pairs are doing at the moment, just ranging around. And that's, you want to know the reason why this 65, 50, 60 area is solid? Because we've been up here plenty of times before, and it's a bit of a pivot point. When we get above, we try and hold above, but those holds haven't lasted. So when we've had another move under, move back up, that's the place it's going to run into trouble. So it needs something different. Like a lot of pairs at the moment, it needs a catalyst to move. Is the NFP going to be it? You know, if it's a really stinky NFP on Friday, it's all about rates for the Fed. Does it cement just a September cut, or does it mean they're going to cut more, cut the next 3 meetings? So that's what we're going to be trading, and that's going to define things like this. If the NFP is really bad and the market thinks, right, they're going to be cutting every meeting for the rest of the year and into 2026, then we're probably going to see this up through 66. But it will be the US fundamentals that are driving this, not the Aussie fundamentals. Right, so we looked at US sterling, looked at Aussie Kiwi, quick look at the old dollar MEX, and a little bit of a lesson I want to give you guys. Okay, it's easy when you trade levels and, you know, talking about this 1850 level for weeks and weeks and weeks and weeks before we even got down here. Let's put it on a bit of chart. But if you're trading charts, okay, if you're trading the techs, okay, you've been probably watching all this and it's been up, it's been down, it's been up and it's been down and whatnot. Okay, we've been talking about this level for months and months, as I say. If you look at this on that, okay, ask yourself, why have you not been trading? If you haven't been trading this, ask yourself why you have not been trading a pair that holds a level for, we're into 3 months now. 3 months of not getting through this 1850. Okay. This is, if you're trading text, this is what you want to look for. You are not going to get a more perfect scenario of technicals working against a number. Okay. It doesn't happen all the time, but when it does, you get this move. So for 3 months, you could have been making money off of this 1850 level. Okay. It doesn't matter whether it breaks down. Doesn't matter whether it shoots up. This is not something you need to worry about whether it's going to go to 21 or whether it's going to go to 16. In the meantime, if you're a technical trader, you should have been trading this in one way, shape, or form, because we've been here, as I say, for 3 months now. Now, the picture suggests we're in a downtrend for the year. That's still valid. We're not moving up. Nothing changes until we're getting above this 19 level. We've had another failure up here at this 1882, 85 area. Okay, so the bearish short-term picture still remains. But as I say, this has been a level that has been holding now for 3 months. That shows you the power if you can identify big levels and if they do something. Gives you a chance to get in a trade and try and work a trade for a good period of time. Now, you may be long and you might break down and you might lose a bit of money, but you may have made money in the meantime trading all those bounces off of the 1850. So a lot of you guys get stuck into the 15-minute charts, the short-term charts. This is where you need to be looking at your long-term charts, because if you see something like that, you've got to be thinking yourself, why am I not trading that? Why am I not trading against this big level? Because you're not going to get things as perfect as this that often. Now, be careful if we trade down there again, because it would mean we've been knocking on the door several times. But just, you can identify these sorts of levels in all your charts if you take a look at the wider picture. Kay, what's your thoughts on this one? Can't get out of the box, but we're still holding it.
Look at what most currencies are doing. Even the mix is less, I would say, it's getting a more maybe it's still moving and faster than what euro dollar does, and so, but it's like only a semi-emerging market anymore, I think, because the a lot of people are now looking and trading MEX because of the past years, what's been going on, obviously, or USMCA, etc. But yeah, it's firmly in ranges. Every time you go up to 85, it's finding a top, and every time you go down in the 60s, it's finding a bottom. So the range is there, as is with most of the developed countries players now nowadays as well. I've been saying since the start of August, I think we are going to potentially build a few ranges, and that's exactly what's happening. Euro dollar, even the cable, when the euro sterling went higher, when the gilt market went down quite quickly, even the cable, we had that look under 133.65 couple of tries. I'm having a big level at 133.65. I don't know where I can show it again. But this 133.65, we had a couple of tries below, and it bounces again, and there's your range. We're back in the range. Whether it's cable, euro sterling, even dollar yen is in the range. But dollar yen is still slightly different, and we may perhaps see a bit of change coming in the dollar yen. But there again, you look at that 146.5, 147, and then up to 149. Quick peak above yesterday morning, quick peak below last week, and we're back in the range, right? Yes, the difference there is still that the yen crosses are relatively big. If you look at, as I said yesterday, sterling yen, even with everything that happened in the sterling, is still above 199, so close to 200. Euro yen as well is still above 172, nowhere near the big supports 170, 171. It's still a bit weaker, but I'm not going to say that I'm going to buy yen. But I want to see the market reaction if they effectively put the seal on that Japanese deal. Okay, I want to see because there may be a bit of a market reaction. It's been long to come, and I also still think that the global deal, yes, the auto sector will be happy because they will be fixed on what's going to happen, but the global deal with all those investments into the US and that buying of US stuff, the global deal is not a brilliant one for Japan, I would still argue, but we may see a bit of deal signature effect, I would call it. So I'm not short yen right now.
Yeah, but as Brand's noted as well, we've got a bit of divergence between what's going on in dollar yen and US yields, which could be having a
They're
little break
decoupled.
under the 420. So yeah,
They're
we're seeing
decoupled.
we're seeing a global yield move at the moment. But
It's
yeah,
the
and I think there's probably a little bit of NFP in that as well, bit of feet coming off the gas pedal. So it could play a little bit of catch up. I mean, if this NFP is bad, then dollar yen's probably going down a good chunk.
Yeah, yeah.
But then looking at its performance right now, you've got to think maybe that dip is going to be hoovered up.
I'm going to I'm still of the opinion that if we get a surprisingly good jobs report, dollar yen is probably the one that's going to fly faster than other dollars.
Yeah,
One of them. One of them. Because of if you need to, let's say, reduce your expectations for rate cuts, forget about like percentages and stuff. I've been saying that on the face as well. But when the bond market needs to reprice expectations for cuts, perhaps if we get a really good report, it's probably going to have an effect on the dollar yen, because then the market will start to think again about the correlation. Every dollar will rally, but dollar yen, in my opinion, is one of those who could rally the fastest. In turn, if we get really bad one, it's probably going to go down, and then we will have to have a look at the other correlation, which is, well, first of all, rates. But are the equity markets going to collapse? Because if the equity markets collapse, then in turn your dollar yen may be the faster mover, because that is something where risk won't like it, and there we know that it's probably going to weigh on yen crosses as well.
yeah, very much so. Right, mate. Let me get it over to you.
Yeah, but it's already quite late.
Yeah,
I'm just perhaps. I mean, I don't really have a lot to show. Let's just look at a couple here.
you're on mute, mate.
Sorry about that.
That's all right.
Yeah, no, I was saying, Derej, that you should really come and join us in our community, mate, because we speak about those things day in, day out. But yeah, I mean, still very, very bullish. There's no two ways about it. We did rally above that 35, 40, 45. Went higher. This is that Chinese declaration, Chinese statement on perhaps trying to curb speculation, because it may be counterintuitive, but it is actually a logic move, because if you speculate on stock markets and they go up, and then at the same time you diversify your monies into gold, etc., which the Asians are doing, and still on the ball. It is also true that if you get a sell-off in stock markets, you will see the effect on stuff like gold, and actually we have seen the effect, as I was noting earlier on the show, on the Aussie dollar as well. But it's already coming back up, and it is still your perfect hedge against everything that goes bad. This one is just big. Watch 3,500, 3,600. I've actually let mine go. As I said, I don't know if I let it already go on the flow show or before the flow show, but yeah, I'm actually flat on gold right now. But it's been a good ride. But I want to see what's happening. The thing is, though, I may actually, if comes down a little bit, just get that the tiny bit back in, because if, as Ryan was also talking about it, that Supreme Court, imagine that they say that tariffs are illegal. This thing is probably not even going to see the 3600, and we could be trading higher a lot faster. And then we were talking probably about 3900 or so. But if everything goes smoothly, let's call it that way, and if we even get a report out of the US job market, which is not too bad, I can see a bit of retracement coming. Now down to where we can go, maybe we'll have a look at it tomorrow, because I'm not sure that ADP challengers could really make it move $100. But yeah, get back below 3500, then I think we may see a low 3400. But then it's probably going to do something like this, because nothing is going to change, especially not geopolitical front, etc. The mix, the cocktail for gold to continue higher is still extremely present. I'm just thinking that it may not be the one-way ticket, and we have come already a long way. It will probably go higher, but I would not be surprised to see a correction. And the last one that I'm going to show for today is silver. I've changed my trend line because it just a much nicer channel actually. I've put it from here, and then it would come like up in the clouds. But look at what it did yesterday. Not yesterday, the weeks before, I was saying like 41.55.60 was my target. So I did take quite a few off yesterday on that blip higher of my long-term position, because this could be close enough for government work right now, and I want to see what's going to happen here. Okay, again, enough US job reports, quotas, whatever, to decide on the next move, but it could be enough just right now. Okay, I'm not saying can't go to 45, but this is a pretty big level. It's a level on that trend line as well. And also, as I said, in the shorter term, if you look at the last decent correction, it is the 1.618 extension as well. I know some people are looking at those extensions. That was there as well. Anything else to comment about? Aussie has been done, I think. I think the level you put your stop at 65.52, Ali. I think it's a bit in between levels. 65 is probably a better level to put it above if you want to be short. I'm rather to the other side on the Aussie still. If I have to be honest, I mean, I'm not in it, but I wouldn't mind buying a few dips again, unless I get told different otherwise by data. Okay, now that's it for me, Ryan. Just looking at the clock. Back over to you, mate.
Thank you very much, sir, and thanks for covering me while I was off to me jollies. I'm sure you did the viewers proud. Thank you, everyone, for coming to the Flow Show. Have a great day, everybody, and we'll see you for NFP Friday tomorrow. Have a good one.